Hey everyone, Couch Investor back to another video for today. So, earnings season has officially begun here on the channel. Netflix earnings report, it beat on earnings per share, beat on the net paid ads, but it missed a little bit by $10 million or so on revenue. Not such a big deal in my opinion. Solid report if you're asking me. Now, when the report got released, the stock went down just like that, around 8% or so, but right now, I'll pull up the most updated one on the screen. It's close to flat. Now, free cash flow back on track. Well, on track to beat their own projections for 2023. So great there. Nothing else to add, to be honest. A good report for Netflix. They're showing why they're the leader in the streaming world. They're showing why they are becoming more and more profitable over time. Again, like I said, 1 year ago, when everybody was saying Netflix was dying, the stock was down what, close to 60% or so back then, and now it's close to double, if not more. As always, look at what the company is doing and not what the overall noise is saying, because usually there is a big disconnect. Not always, but usually there is. We've seen this with Tesla, we've seen this with Meta at or near bottom. So we're going to go and have a look at this earnings report. If you want to have a lot of summaries of this earnings season, do me a pleasure by hitting that thumbs up button. Subscribe if you have not. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So first things first here, we're going to start with this. So they got a Moodys upgrade. So they achieved investment grade status. Netflix is the leading streaming service based on engagement, revenue, and profit, and we're working to build on that in 2023 by seeking to expand operating margin to 18 to 20% and to generate at least $3.5 billion of free cash flow, up from their prior expectations of at least $3 billion of free cash flow. So let's have a look at the numbers right here. Revenue increased 3.7% year over year. Operating income, nice increase there, $1.71 billion. Operating margin back on track here, so 21%. And it was a beat as well on their own expectation. Net income, $1.3 billion. Diluted earnings per share, $2.88 there. So a beat on that as well. If we're looking at global streaming paid membership, that reached now 332.5 million. That's up 4.9% year over year. Global streaming paid net addition 1.75. And don't worry, we will go and look at forecast in just a bit. Net cash provided by operating activities, back up a lot, 2.17 billion. Free cash flow, $2.11 billion, up by a lot if you look at the previous quarters here. And then forecast for Q2. Yes, we're not getting forecasts anymore, or specific forecast for global paid net additions, but we get more information later on in this report. So they expect revenue to grow 3.4% year over year to $8.24 billion. Operating income of $1.56 billion. Operating margins, again, 19%. Remember, they are planning for between 18 and 20%. So sometimes it will be 21, sometimes 19, and so on and so forth. Net income, $1.28 billion, and then diluted earnings per share, $2.84. So as we continue to look here, so forecast, their primary financial metrics are revenue for growth and operating margin for profitability. They continue by giving us a bit more information. So the majority of our year-over-year FX neutral revenue growth in Q2 is expected to come from growth in our paid membership base. This translates in Q2 paid net adds that are roughly similar to Q1, and slight increase in the year-over-year FX neutral arm, limited price increases during paid sharing rollout. Now they expect constant currency revenue growth to accelerate over the course of the second half of 2023 as they continue to improve the service, more broadly roll out paid sharing in Q2, and grow the advertising business. More on that later on. We also expect year-over-year operating profit growth and operating margin expansion for the full year, assuming no material swings in FX. We're still targeting a 2023 operating margin of 18 to 20% based on FX rates as of January 1st, 2023. Now, when it comes to engagement, I'll pull up the graph that you can see here below. So engagement is important to success in streaming because it drives both retention and acquisition. The third-party data in the chart below shows that Netflix and YouTube are the clear leaders in streaming engagement and that the opportunity ahead is significant as streaming still counts for the minority of viewing in every country. We remain highly confident that streaming's shares of engagement will continue to grow at the expense of linear since it offers a better experience, on-demand availability across devices. We believe this gives Netflix tremendous room for growth if we can continue to improve our service, increasing our share of total viewing by multiples higher than today's 2 to 4% share in Brazil, Mexico, and Poland, or 7 to 9% share in the US and the UK. And I 100% agree with this. I think every streaming player right now will just become bigger and bigger as they take more and more from that linear pie. Now, when it comes to monetization and revenue, so they say our engagement on the ads tier is above the initial expectations, and as expected, we've seen very little switching from our standard and premium plans. Also, thanks to our most recent set of licensing deals, our ad-supported plan now has on average around 95% content parity globally by viewing with our ads-free plans, including all the latest Netflix shows and movies. On the advertiser side, we are launching a programmatic private marketplace to enable more buying options for Netflix ad inventory using Microsoft's sales platform, which was announced a couple of months ago. Our partnerships with Integral Ad Science and Double Verify are also live, validating campaign engagement of ads viewership on Netflix. Now, some more information with regards to paid sharing. So they say it's another important initiative as widespread account sharing over 100 million households undermines our ability to invest in and improve Netflix for our paying members as well as build our business. So they're pleased with the results for the Q1 launches in Canada, New Zealand, Spain, and Portugal, strengthening our confidence that we have the right approach. As with Latin America, we see a cancel reaction in each market when we announce the news, which impacts near-term member growth, but as borrowers start to activate their own accounts and existing members add extra member accounts, we see increased acquisition and revenue. They talk here again about competition. They say they want to focus on their own business, saying that they are streaming only, whereas some competitors are streaming and linear. I'll take the comparison here that, well, Tesla is just an EV maker, right? They focus only on EV, whereas the competition should focus on EV and also ICE, because if they just leave the ICE, or in this case, the linear business, well, they'll probably go bankrupt or be close to bankruptcy. So again, the comparison here, Netflix fully focused on just streaming, whereas the competitors are still streaming and linear, which is a bit more difficult to handle. And last couple of things here. So for 2024, they still expect the cash content spend to be in the range of roughly $17 billion, consistent with the prior expectations for 2022 to 2024 period. Then if we scroll down, we have this announcement here, very, very sad for the OG ones here. So after an incredible 25-year run, they've decided to wind down DVD.com later this year. Rest in peace. Now, if we look over the regional breakdown, we can see that every region, besides one, has added new paid net ads. So UCAN added 0.1, EMA added 0.64, LATAM lost 0.45, which the reason we gave just before. APAC added 1.46. And yes, of course, these numbers are in millions. So to conclude, overall, to me, pretty solid quarter for Netflix, very, very solid business now and in the future as well. I like the service, although sometimes, yes, some shows, some movies are a bit garbage. But overall, I think they're doing a very, very good job. The profitability of the business just becomes better and better. To me, it's a pretty good company to have in your portfolio. Of course, I don't own it, but the amount of times that I do it, mention it on the channel, some of you might think that I do, but actually I don't. But hey, if you are one of the Netflix shareholders, do let me know your thoughts down in the comments below. If you enjoyed this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.